Oil prices continuing to fall this morning, shrugging off concerns of heightened geopolitical tension in the region following Iran's attack against Israel this weekend. Still, some analysts expect prices to jump over $100 a barrel. So what impact can we expect this to have on inflation and, in turn, the Federal Reserve's path moving forward? Joining us now, we have Jason Draho, UBS Global Wealth Management Head of Asset Allocation. Jason, thank you for being here live with us at the NASDAQ this morning. We appreciate it. I want to pick up on where we left off there. I'm curious from your perspective, is the risk phase that we're seeing in the Middle East starting to draw to a close, or is this a start of a whole new realm of risk?
Well, we go back to October 7th when Hamas first attacked Israel, so I think we could say we're in an elongated cycle of how this could play out. And this is just another phase. So I don't think it's either the beginning or the end. I think it's just the reality that investors will have to be dealing with. This could escalate at any point in time. It's hard to predict. So it's something that I think it's a risk you have to acknowledge. What we've seen for the past 6 months is clearly not impacted financial market performance. And it's not something that we would think as a base case that this will escalate or at least seriously disrupt the overall macro picture in the U.S. So it's a risk to monitor, potentially hedge, but it doesn't change, I think, for us, the overall narrative of the marketplace.
Jason, could it make it, though, more likely that the Fed is going to stay on the sidelines maybe longer than anticipated if we do see a spike in energy prices and then, of course, the pressure the upward pressure that could potentially put on inflation?
Well, if you're looking specifically at oil, historically the Fed has looked through oil price shocks because you see oil price spike and then it comes down. We saw that in 21. We can go back into like 2007 and 8. So the Fed tends to look at it as transitory. There's sort of an saying in the Wall Street that the solution for high commodity prices is high commodity prices. So I think the Fed would kind of look through that. They'd focus much more on other trends and core inflation, services, the labor market. Are they trending in the right direction? And it's a headache. Optically, it's a headache if inflation is going higher for them to cut, but I think it doesn't necessarily change their overall strategy.
Well, if that is the case, then I'm curious from your perspective, what is more likely? Is it more likely that we're going to have a rise in oil, keeping inflation high, meaning higher for longer, or that geopolitical shocks could potentially put pressure on the economy and lead to a quickening of rate cuts?
Well, I think if you need to see a significant spike in oil prices, so like to 120 plus for it to really start to impact the U.S. economy. Because, you have to understand the U.S. is now the biggest oil producer in the world. It's about 13 million barrels a day. So as a result, when oil prices go up at these kind of levels in the $80, $90 to $100 range, the net effect for the U.S. economy overall is somewhat neutral. Certainly worse for the consumer, you're paying more at the pump, but the energy sector production actually offsets some of that from overall economic activity. So you really have to have a bigger spike for it to start to impact consumer spending, for the Fed to think, well, now it's actually going to slow down and therefore to be preemptive, we need to cut. So as where we are in the range right now, it's sort of noise for the market as opposed to like really a tail risk that's kind of escalating. So I think, again, at these levels, it doesn't alter what the Fed's likely to do.
So what is your reading then on inflation? Because here we are on the heels of 3 hotter than expected prints. We also got another strong read on the economy this morning when it comes to retail sales. Are you confident that this disinflation trend is going to resume and then continue?
I'm not as confident today as I would have been a week ago. I think that's an easy thing to say. But if you sort of look at the details of where inflation is likely to go, I have some reason to be a little more confident that it still will continue as a downward trend. Bumpy, not necessarily smooth, but by year end, core inflation will be lower. One thing is if you look at the core CPI ex shelter, it's 2.4%. With shelter, it's 3.8%. Then if you look at sort of real-time data on rents, it's all indicating that the shelter piece will continue to go down. The other thing that when people talk about inflation reaccelerating, no one's talking about how there could be a wage price spiral, because if you look at the labor market and wage inflation, almost every single measure is going to lower. Average hourly earnings, the Atlanta Fed, kind of wage tracker, the employment cost index, they're all suggesting wage is going to moderate. That doesn't mean price inflation is going to go lower. The relationship is a little bit loose, but it's hard to see inflation reaccelerating if wage growth continues to moderate as it has. So the trend to me is inflation will continue to come lower. It just maybe not going to be as smooth as quickly as investors were anticipating 3 months ago.
In that dynamic, what will drive more growth for equity markets when we have such record-breaking valuations?
I think if you look at where GDP could be tracking after the retail sales, it could be close to 3% in Q1. You have 3% inflation or more, that's 6% nominal GDP. No change in margins, you're talking about 6% kind of potential revenue growth. And then if you get any margin expansion, then you can be looking at high single-digit earnings growth, especially in the tech sector, which is more of a micro idiosyncratic story, like with AI, the same thing in healthcare with some of the obesity drugs. So you have a macro story that could be relatively favorable, but you also have these secular thematic tailwinds. So all of it suggests earnings should kind of grow relatively robustly this year. It would really take something, again, inflation being sticky, really accelerating, that takes the Fed completely off the table. maybe you have rate hikes be a possibility. I think that's the thing that would be the most difficult for the markets to deal with at this point in time.
Jason, when you take a look at the action in the bond market, you have yields heading back higher once again today. What do you think that action is going to look like? Are we going to remain range bound? Could we retest that 5% level?
So I think our range would be for the 10-year around 4 to 4.5%. So we're breaching that a little bit higher. To go much higher, to go back to the 5%, you start to, I think, not only have to price out, rate cuts this year, but also next year, and even kind of bring back the possibility, could the Fed have to hike again? There's been a pretty good relationship, it's not perfect, between where the 10-year is and where the market is pricing for the terminal Fed funds rate, kind of looking out a few years. Meaning, is the Fed going to be able to cut 10 times ultimately in this cycle, or only 3 or 4? If it ends up being the latter, well then, maybe you go back to kind of 5% on a 10-year. I think what happened last October is when you got to 5%, a lot of investors who are saying, like, I'd rather sit in cash. Now, if you can lock in at 5% in a 10-year, given the fact that the Fed is very close to cutting rates, that's a pretty attractive bid in the market. So whether we get to 5% or 4.75, I think, sometimes you can just have short-term momentum, but I think there's going to be a lot of resistance for rates to go much higher, unless we really fundamentally alter what we think where the economy is headed in over the next few years.
All right, Jason Draho, great to have you here in person with us at the NASDAQ, UBS Global Wealth Management, Head of Asset Allocation. Thanks so much, Jason.
Thank you.